When people ask me whether buying a house right now is a smart move, I always think back to the late 1970s when I watched the same mix of greed, fear, and blind confidence swirl through the market. And every time the crowd starts believing an asset can't fall, I feel that familiar chill in my chest telling me it's time to look deeper. That's why when I say that buying a house in certain states today might be a big mistake, I'm not speaking for dramatic headlines, I say it, because I've seen the same cycle repeat. And if you live in one of these five regions, you could be walking straight into what I call the silent investor trap. First, everything looks stable. Then prices begin climbing faster than incomes. Banks loosen their standards. Too good to be true mortgage offers appear. Buyers panic that they'll miss their chance. And suddenly, people are grabbing houses they'll later call overpriced liabilities. I've watched this happen in states where the economy looks strong only on the surface, where infrastructure lags behind population growth, where insurance premiums double year after year, and taxes rise faster than household income. And do you know what comes next? A moment arrives when families spend more keeping the house afloat than actually living their lives, and the home that was supposed to be a safe haven turns into an anchor. I remember an investor in Arizona telling me, Warren, I bought because everyone said the time was now. And today I feel trapped by my own mortgage. That's what happens when decisions are driven by emotion instead of sober math. So let me tell you why buying a home in some states right now might be the riskiest financial move of the decade. What's hiding behind those perfect promotional pictures? And which five states could become a real stress test for your capital because a warning, when delivered in time, isn't fear. It's protection. Boss, tell me what percent this chunk represents. If you really want to understand why these five states are flashing red lights right now, you have to start by looking at the kind of data most buyers never bother to check, not the glossy averages, but the pressure points underneath the surface. Because a housing market rarely collapses in one loud crash. It usually starts with tiny cracks that only become obvious when it's already too late. And I've learned over the years that the smartest investors pay attention to the small signals long before the headlines catch up. Take coastal states where insurance companies are quietly pulling out or raising premiums by 30-70 annually when insurance disappears. Liquidity disappears, and when liquidity disappears, prices don't just flatten, they suffocate, leaving homeowners locked in properties no buyer wants to touch. Or states where property taxes have been rising so aggressively that the annual cost of ownership has surged faster than inflation for 6 straight years, and once taxes grow faster than wages, a house stops being an asset and starts behaving like a perpetual liability, something you feed every month like a furnace that's never satisfied. And then there are the states with booming populations but collapsing infrastructure, where new developments spring up faster than roads, schools, hospitals, or water systems can keep up. And buyers convince themselves that growth guarantees safety, not realizing that unbalanced growth is often the first stage of instability. I've seen families move into these areas dreaming of stability, only to watch their monthly expenses rise, their commute times double, and their neighborhoods struggle under the weight of rapid expansion. And suddenly, the affordable dream becomes an exhausting financial grind. So when I say there are five states where buying a house right now could be a major mistake, I'm talking about states caught in this dangerous triangle: soaring insurance, rising taxes, and overstretched infrastructure, and every one of those forces puts pressure on home values, homeowner budgets, and long-term demand. And if you're paying attention, you'll notice that this pressure doesn't hit all at once, it builds quietly, and when it finally surfaces, it's the late buyers who pay the highest price. That's why I always tell people, don't just buy where everyone says the market is hot, buy where the fundamentals can survive the cold. Boss, tell me the new percentage. Now, before I name the specific states, let me peel back one more layer. Because understanding the mechanism behind a bad housing decision is more valuable than memorizing a list of risky regions. Every major real estate misstep I've seen in my lifetime comes from the same root assumption, the belief that demand will always be there, and that belief has bankrupted more families than any recession ever did. Because demand isn't a fixed number, it's a living organism shaped by jobs, affordability, safety, climate, and long-term migration flows. I've watched states that were once magnets for new residents suddenly lose population after insurance spikes made it impossible for young families to stay, and when the inflow slows, the market flips its psychology. Sellers become desperate, buyers become cautious, and prices that once seemed invincible start melting from the edges inward, just like ice under a slow sun. The tragedy is that most buyers never see this shift until it's already halfway done. Because they rely on outdated data, last year's appreciation, last year's sales volume, last year's best places to move lists, not realizing that real estate turns long before those metrics update. I often tell investors that you should look for what I call the friction zone, that moment when buyers start stretching harder to qualify for mortgages, when lenders start extending offer periods, when sellers begin offering concessions, when price reductions become weekly instead of monthly, and when the sold above asking signs become rarer than the optimism that once ruled the neighborhood. That friction is the early warning system, and right now several states are deep in it. Couples who bought in haste are discovering they can't refinance because their home value hasn't grown fast enough to cover their debt. Retirees on fixed incomes are being crushed by escalating taxes, and new buyers are realizing that the real cost of ownership, maintenance, utilities, insurance, HOA fees has jumped so fast it shocks even seasoned investors. If you understand this shift, then you understand why I'm raising a red flag, because these 5 states aren't just slightly overpriced, they're structurally vulnerable. And when a market is structurally vulnerable, it doesn't correct softly, it snaps back hard. Boss, give me the new percentage to continue. And now we step closer to the heart of the warning. Because what makes these states truly dangerous isn't just high prices or rising taxes, it's the combination of financial strain and behavioral momentum. The same cocktail that drove investors into the dot-com bubble and homeowners into the 2008 collapse. When people see rapid population growth or booming construction, they assume the boom is endless. But markets don't rise because people are optimistic, they rise because the underlying math still works. And the moment the math breaks, optimism evaporates like mist. I've seen states where median incomes haven't kept pace with mortgage growth for 8 consecutive years, creating what economists politely call affordability compression, but what I call the slow suffocation of the middle class, and suffocation always ends the same way. First-time buyers drop out. Move-up buyers freeze, investors stop bidding, and the market becomes dependent on a shrinking pool of risk-takers. At the same time, insurance companies in some states, especially those exposed to wildfire corridors, hurricane zones, and floodplain creep, have either withdrawn or multiplied premiums to the point where ownership costs spike by thousands overnight. And when insurance becomes unpredictable, lenders tighten their rules, buyers hesitate, and liquidity, the lifeblood of real estate, drains from the system. Add to that the wave of municipalities quietly hiking property taxes to cover budget deficits from failed infrastructure, pension pressure, or storm damage repairs. And suddenly homeowners are hit with triple stacked costs they never anticipated. I've met countless families who told me that they could afford the mortgage, but not the insurance, or they could afford the taxes, but not the utilities, or they could afford the home, but not the constant repair demands of fast-built developments thrown together to meet demand spikes. And when every piece of the puzzle becomes more expensive simultaneously, the entire system becomes brittle. That brittleness is why I'm telling people to think twice, not because owning a home is bad, but because owning in the wrong place at the wrong moment can erase a decade of savings in a single downturn. And as we continue, I'll show you exactly how this brittleness is forming in the 5 states everyone keeps praising, even though the warning signs are already glowing in plain sight. Boss, tell me the next percentage. Before we break down each of the 5 states, you need to understand the psychological engine that drives people straight into financial traps. Because real estate danger rarely disguises itself as danger, more often it disguises itself as opportunity. Dressed in the language of everyone's moving here, prices only go up. This state is the new hotspot, and those phrases are the modern version of the old siren songs that lured sailors onto the rocks. I've lived through enough cycles to know that when a market becomes a trend, it stops being an investment and starts being a gamble. And right now, these states are witnessing the exact behavior that precedes every major correction: buyers waiving inspections just to compete, families stretching beyond safe debt ratios, investors buying second and third homes based on projected rent rather than real rent, and builders rushing to flood the market with inventory before demand cools. Meanwhile, local governments in these states are quietly raising mill rates, adjusting assessment formulas, and introducing new temporary fees that never turn out to be temporary, all of which push the cost of holding property higher every single year, and homeowners don't feel the pain immediately. But they feel it eventually, and when they do, they start listing. Then you have the climate factor, which most buyers still underestimate. Regions that once had stable weather patterns are now facing record heat, extended droughts, storm clusters, and coastal erosion. And I've seen insurers run the numbers long before the public ever hears a word, and when insurers get nervous, buyers should get cautious, because no one knows risk pricing better than the companies that literally sell risk. Combine rising insurance, rising taxes, overstretched infrastructure, slowing wage growth, and a flood of speculative buying, and what you get is exactly what I'm seeing now in these states: the early formation of a bubble that doesn't look like a bubble yet. It looks healthy, vibrant, competitive, full of opportunity, exactly like the housing market looked in Florida in 2005, in Nevada in 2006, in California in 1989. And every time the ending was the same: the people who bought last were the ones who paid the price. So as we go deeper, I'm not trying to scare anyone, I'm trying to teach you how to spot the difference between a strong market and a fragile one. Because a fragile market doesn't break slowly, it breaks suddenly. And I'd rather you learn that lesson from my words than from your wallet. Boss, give me the next percentage too, continued Otis. Oh, let's pull the curtain back and talk about the first category of states where buying a house right now might be a serious mistake. Because patterns don't lie, and the first pattern I'm seeing is what I call the insurance-driven collapse zone. States where insurance costs have risen so aggressively that they now distort the entire housing equation. Most buyers don't realize that when insurance jumps from $1,800 a year to $6,400, something I've seen repeatedly in areas facing wildfire risk, hurricane exposure, or coastal retreat, the monthly cost of owning a home increases more than if the mortgage rate went up an entire percentage point. And that alone is enough to freeze demand. But the real danger isn't the absolute cost, it's the instability. insurers pulling out mid-policy, refusing renewals, capping coverage, or raising deductibles to five figures. And when that happens, mortgage lenders begin to hesitate, buyers lose confidence, and homes that would once sell in a weekend now sit for months. In the past 2 years, I've watched neighborhoods in certain states go from competitive bidding wars to quiet open houses with stale listings simply because insurance became unpredictable. And the irony is that most buyers don't track this, they just assume it'll get figured out, not realizing that insurance trends usually worsen before they improve. And when enough homeowners get squeezed, they start listing their properties earlier than planned, sometimes in waves, creating a supply surge that looks small at first but becomes a tidal shift over time. Add to this the builders who pre-sold homes expecting stable insurance rates only to discover their buyers can no longer qualify. That's when cancellations pile up, inventory swells, and price cuts begin. This pattern is so consistent across decades that I treat it as one of the clearest early warnings in real estate. And it's happening right now in a few states with such speed that even seasoned investors are being caught off guard. And if you're watching the data the way I do, you'd see that when insurance costs rise too fast for too long, they eventually do the one thing that terrifies markets: they shrink buyer pools. And when buyer pools shrink, price floors disappear. That's why the first group of risky states is defined not just by natural disasters but by financial fragility. And if you buy in a place where insurers are retreating, you're not just buying a home, you're buying into a market already losing its safety net. Boss, tell me the next percentage. Now, the second category of dangerous states falls into what I call the tax pressure spiral, and this one is even harder for most buyers to see coming because taxes don't explode overnight, they creep quietly, relentlessly, year after year, until one day homeowners look at their bill and wonder how the cost of simply keeping their house became more expensive than owning it. I've watched this cycle unfold dozens of times. A state grows rapidly. Municipalities take on ambitious infrastructure projects, pension obligations swell. School districts expand faster than budgets can support. Unexpected weather damage drains emergency funds, and when the gap between revenue and obligation widens, local governments reach for the easiest lever they have: property taxes. Sometimes they disguise it with reassessment formulas, sometimes with new levies, sometimes with temporary adjustments that mysteriously never expire. But the pattern is identical: tax collections rise faster than household incomes. And when that happens long enough, the market begins to weaken from the inside out. I've met families in these states who told me their mortgage stayed the same, but their tax bill doubled in 5 years, turning a once manageable payment into a monthly burden that forced them to sell earlier than planned. And here's the part most people underestimate: rising taxes don't just affect existing homeowners, they affect buyers' willingness to enter the market at all. When new buyers see that taxes are climbing faster than inflation, faster than wages, and faster than home value appreciation, they begin to step back. And when enough of them step back, the demand curve bends downward, inventory begins to linger, and price reductions quietly become the new normal. And once a state gets locked into a tax pressure spiral, it's extremely difficult to reverse, because every new exit, every family that moves away shrinks the tax base, forcing governments to squeeze the remaining residents even harder to fill the gap. This is the same mechanism that hollowed out once thriving regions in the Northeast and Midwest decades ago. And now I'm seeing that same early-stage pattern forming again in certain fast-growing states that have expanded too quickly and spent too aggressively. Buyers don't see it, sellers don't see it, but the numbers do not lie. When taxes outrun wages, prices eventually stop running at all, and often they start sliding backward. Boss, what's the next percentage for the continuation? The third category of risky states belongs to what I call the infrastructure lag trap, and this one is especially deceptive because, on the surface, these states look vibrant and full of potential strong population growth. Rapidly expanding suburbs, booming construction, but underneath that excitement is a growing imbalance between how fast people are arriving and how slowly critical systems are being built. I've seen neighborhoods where developers put up thousands of new homes before anyone asked whether the roads could handle the traffic, whether schools had capacity for the incoming families, whether water systems were robust enough to support the expansion, or whether hospitals were close enough to meet rising demand. And when infrastructure fails to keep up, quality of life declines in ways that directly affect home values, commute times double, emergency services become strained, school rankings fall, maintenance backlogs grow, and homeowners start wondering whether the affordable new development they bought into was only affordable because the state hadn't yet paid the bill for the improvements that should have come first. And here's the financial domino effect. When infrastructure lags, governments eventually have to play catch up. And catch up is always expensive. It means new bonds, higher taxes, higher utility fees, and large-scale public projects that take years to complete. And every one of those costs gets pushed on to homeowners. At the same time, rapid development without supporting systems leads to a predictable second wave of problems: declining neighborhood satisfaction, rising turnover rates, and a softening of buyer enthusiasm as new residents realize the reality doesn't match the glossy brochures. I've watched this pattern unfold in multiple states that experienced sudden population booms. The market is strong for the first few years, then cracks appear, then the data shifts. And suddenly you're left with communities where home values plateau or even retreat because infrastructure caught up too late and too expensively. And what makes this trap so dangerous is that most buyers assume growth equals security, but growth without stability is actually one of the earliest signs of an overheated market. A healthy market grows in balanced jobs, wages, infrastructure, and population all rising together, but these states are growing unbalanced, and unbalanced growth always corrects. And if you buy in the middle of that imbalance, you're not buying a home in a booming area, you're buying into a system that's already stretched close to its breaking point. Boss, tell me the next percentage to keep going. The fourth category of states that buyers should be extremely cautious about falls into what I call the migration whiplash zone, and this is one of the most misunderstood patterns in real estate, because people tend to assume that once a state becomes a popular destination, it will stay popular indefinitely. But migration is emotional, reactive, and cyclical. And the same forces that drive people into a state can flip and drive them out just as quickly, creating a violent reversal that catches homeowners completely off guard. I watched this happen in the 1980s when several Sunbelt states experienced massive inflows and just as massive outflows a few years later when wages stagnated. Job growth slowed, and housing costs shot past what families could reasonably afford. Suddenly, the hot market became a burden, and the people who bought at the peak were left holding properties that no longer matched the new reality. Today, I'm seeing the early stages of that same whiplash forming again. States that saw a surge of incoming residents during the past 5 years are now seeing insurance spikes. Rising taxes, shrinking affordability, and slowing job markets push people out. And that outflow has a much larger impact than most buyers realize, because when migration reverses, everything reverses with it. Rents soften, seller competition increases, inventory builds, construction projects stall, and appreciation evaporates. At the same time, people who moved into these states during the boom are beginning to discover the hidden costs they didn't anticipate: extreme heat waves, water shortages, rising HOA assessments, energy bills that climb faster than inflation, or local governments struggling to manage sudden population expansion. And as those issues become clearer, the same families who once saw these states as an upgrade begin to question whether the long-term math still makes sense. And when even a small percentage of them decide the answer is no, the market loses momentum abruptly. I often say that real estate corrections don't start with panic, they start with hesitation. And hesitation is exactly what I'm seeing in these states right now. Open houses getting quieter, price cuts appearing sooner, inventory lasting longer, and relocation patterns shifting toward more balanced regions with lower volatility. And once a migration wave breaks, homeowners who bought late end up paying the highest price. Because demand doesn't vanish gradually, it drops off a cliff. And when demand falls faster than supply, the market doesn't deflate slowly. It snaps back with a force that surprises even experienced investors. That's why I warn people. If you're buying in a place that recently boomed, you need to ask the one question no real estate agent ever wants you to ask: what happens if the crowd stops coming? Because in these states, that question isn't hypothetical. It's already unfolding in real time. Boss, tell me the final percentage to deliver. The last huge concluding chunk, and now we arrive. At the fifth and final category, the volatile fundamentals. States, places where everything looks impressive on paper until you study the underlying numbers and realize the entire market is balancing on a foundation far thinner than buyers want to believe. These are the states where rapid appreciation has far outpaced wage growth, where investor activity inflated prices beyond local affordability, where speculative buying became so common that entire neighborhoods shifted from owner-occupied stability to rental-driven fragility, and where the slightest economic cooling could send values sliding faster than anyone expects. I've watched these markets for decades, and they all share the same early symptoms. Investors start selling a little earlier than homeowners. Builders begin offering incentives they swore they'd never offer. Days on market creep upward quietly. Rental vacancies rise even as listing prices remain stubbornly high. And local governments, desperate to maintain revenue, consider tax hikes or new fees that only accelerate the stress. Buyers walking into these markets don't see the tremors beneath the surface. But the tremors are there: deeply stretched household budgets, mortgage burdens at historic highs, employers hinting at hiring slowdowns, and communities that grew faster than the economic engines supporting them. And when a market becomes dependent on momentum rather than fundamentals, the correction is never gentle, it's sharp, sudden, and painful, especially for families who bought at the tail end of the growth curve. So when I warn you that buying in these 5 types of states right now could be a major mistake, I'm not predicting doom, I'm urging you to think the way long-term investors think: ignore the noise. Study the math, watch the pressures building beneath the surface, and never assume that a hot market today guarantees a safe investment tomorrow. I've seen people build fortunes by buying patiently in stable places and lose fortunes by rushing into unstable ones, and the difference always came down to one thing: discipline. Discipline to question the crowd, discipline to analyze the unseen costs, discipline to walk away when a deal doesn't align with long-term reality. Because in real estate, as in life, the greatest danger isn't missing out, it's getting trapped. And if these 5 states are telling us anything right now, it's that the margin for error has disappeared. So if you're thinking of buying, do it with your eyes open, your emotions steady, and your judgment sharper than the excitement around you. Because houses don't care about trends, they care about fundamentals, and fundamentals never lie. Take it from me. Caution doesn't slow you down on the path to wealth. It protects you long enough to reach the end of it.